Welcome back to Wall Street Week. All right, Jim, let's talk about some stocks, some follow-ups. You came on this program, you talked about Valiant. It was a tremendous short. News out this week that 2 executives at the company were arrested. Additionally, you've got some insights and thoughts about what's happening with the company and what's happening with all of these companies right now that have been looked at by the Congress.
Yeah, it's an interesting, Valiant's an interesting example of what we were talking about. What we've noticed this year, and Valiant was one of the poster children for this, is kind of a sea change on Capitol Hill as well as on Wall Street, in that for the first time now, these corporate wrongdoers or alleged wrongdoers are getting grilled in Congress. If you think about Wells Fargo, if you think about Valiant, think about Mylan, by both parties. And it's not just the left wing of the Democratic Party that is ripping into these perceived ripping off of consumers. It's both parties. And I think that plays back into what we were talking about. Are we seeing a change in the roles of the parties? Is the Republican Party becoming the party of the average person? And if so, what does that mean for the ability of corporate America, for example, in the pharmaceutical industry, to just keep raising prices, even though it's free market? And we can sort of think through a lot of these things, and what we thought might be perceived wisdom might in fact get turned on its head. And that's why this is so interesting.
But on Valiant, they have begun to sell off assets. Bill Miller, a legendary value investor, has been out recommending the stock, thinks it could be a triple or even greater. Your thesis is still intact on the short side?
Yeah, our thesis is completely intact on the short side, because this is a company that bought drugs. They did not develop them. And the whole idea was they were buying drugs with a short shelf life of just, only a handful of years before patents expired or competition came in. And they were able to jack prices up 500, 1,000% by gaming the reimbursement system. And that's what this whole Philidor controversy was about. And that game is over. I mean, it is truly over. The ability to take a toe fungus drug and hike prices 1,000%, and get paid is completely over. And while they have some assets like Bausch & Lomb that are reasonably good, I think they still overpaid for that as well. A lot of the drugs they bought aren't going to be worth nearly what they paid for them, and that's the problem.
So what a call, Jim. I mean, really incredible. Congratulations. You called out Valiant when it was all the way up there. You called out Enron when it was all the way up there. What's your big short right now? Come on, tell us.
Well, I mean, a lot of those are only visible in hindsight, Maria. But one name that certainly sort of juxtaposes our views on a couple of different things is Alibaba. And Alibaba, the big internet e-commerce in China, is being perceived as a play on the growth of Chinese e-commerce. And yet when you drill down into Alibaba, it's actually quite an interesting story. And for lots of reasons that are accounting related and corporate governance related, and yet Wall Street's piled into this stock without really understanding the fundamentals of what's driving the business. And my good friend Jim Grant has called China the People's Republic of Madoff, and I couldn't agree with him more. The accounting standards are horrible. The corporate governance standards, you actually don't own the assets if you're a Western shareholder. You own a piece of paper.
And the way the revenue moves is real complicated. The way
the revenue moves and the way they account for the costs, you don't see a lot of them. The delivery costs are off the books.
It's a lot of off-balance sheet.
A lot of off-balance sheet stuff.
But with Valiant, the end game was when they stopped doing the roll-ups and they stopped doing the deals, and then obviously the stuff came out with Philidor. How do you see Alibaba eventually what will eventually crack the Alibaba bulls?
Well, the problem is that Alibaba, unlike Amazon and U.S. e-commerce companies, Alibaba gobbles up cash. It actually is a voracious user of cash. It does not generate cash. And the balance sheet is growing almost twice as fast as the business. And you know enough about corporate finance that if your assets are growing twice the rate of your profits, your return on capital is plummeting. And Alibaba last year employed more capital in 1 year than Amazon has since its inception.
Incredible.
Yep.
Incredible. By the way, in terms of technology, are you surprised that tech stocks have not participated in this Trump rally? And is there an opportunity there, or is that also a sell?
Well, there might be. I mean, again, we have to kind of just step back, Maria, and say the knee-jerk is, oh, tech, Silicon Valley, anti-Trump, not going to be favored. I think probably a more logical thought process would be tech dependent upon exports, dollar rallying, hurting on the margin, and we've kind of forgotten in this whole thing that the dollar's had this rip-roaring rally. Not only have rates gone up, but dollar, which may hurt profits for a lot of exporters. And I think so. It may be some combination of both.
Well, after some excitement and euphoria since the election, it's always good to listen to Jim Chanos to bring us back to reality and remind us what we have to be focused on. Jim, thanks so much for joining us today.
Thanks for having me. It's been great here.
Thanks so much, Jim Chanos. Next week, our guest is IEX CEO and co-founder Brad Katsuyama. We'll see you then. Have a good weekend.